Hey everyone, welcome back to the channel. Today we're diving into a sparkling topic that may surprise you, diamonds. Now we all know diamonds are often marketed as forever and priceless. But when it comes to making smart financial choices, are they really worth the hype? Whether it's for an engagement, a special anniversary, or just a luxurious treat for yourself, diamonds have long been a symbol of love, status, and wealth. But here's the catch. While they're stunning to look at, diamonds don't always live up to their reputation as a smart investment. In this video, we're going to break down why buying diamonds is often not a good investment. We'll cover the hidden costs, resale challenges, and even the impact of lab-grown diamonds on the market. So, if you've ever wondered about the financial side of diamonds, or if you're considering splurging on one, keep watching. From high retail markups to unpredictable resale value, there are some big reasons why diamonds don't quite shine as bright when it comes to building wealth. And don't worry, we're not here to discourage buying diamonds altogether. We're just here to give you the facts so you can make a well-informed choice. So hit that like button. Make sure to subscribe if you haven't already, and let's dive into why diamonds might not be the financial gem you think they are. Alright, let's talk about one of the biggest reasons why buying a diamond isn't considered a great investment: the high markups and the disappointing resale value. When you walk into a jewelry store to buy a diamond, you're not just paying for the stone itself, you're also paying for the jeweler's markups, which can often be as high as 100% or even more. Why so high? Well, the price tag includes overhead costs like store operations, marketing, brand name, and, of course, profit margins. And this markup is one of the main reasons you'll almost never get back what you paid for the diamond when you try to resell it. Think of it this way. If you buy a diamond ring for, say, $5,000, the actual wholesale value of that diamond might be closer to $2,000. The moment you walk out of the store, the value of that diamond drops significantly because buyers in the resale market are only willing to pay wholesale prices or even less. This means that if you try to resell it, you'll likely only get a fraction of what you paid, sometimes as low as 40% of the retail price. So, unlike gold or stocks that hold a more universally accepted market price, diamonds have no standard pricing that guarantees a good return. The resale market for diamonds is far less structured, which means you're often selling to jewelers, pawn shops, or individual buyers who are looking for a deal. They're unlikely to pay anywhere near what you originally spent. And here's another twist. The high retail markup is largely influenced by the diamond industry's heavy marketing. From the "Diamonds Are Forever" slogan to luxury branding, the industry has created a perception of value that doesn't necessarily translate to investment value. At the end of the day, buying a diamond often means paying top dollar for something that's unlikely to appreciate, and that could lose a significant portion of its value if you try to sell it. So, while diamonds are beautiful and may have emotional value, as a financial asset, they don't stack up. High retail markups and low resale value mean that diamonds are better seen as a luxury purchase rather than an investment. Next up, let's talk about something that investors really care about: liquidity, or, in the case of diamonds, the lack of it. In investing, liquidity is a key factor because it refers to how easily you can convert an asset, like a stock or bond, into cash at its current market value. Diamonds, unfortunately, are not very liquid assets, which means they're tough to sell quickly without taking a hit on the price. Let's put it into perspective. If you own shares of a popular stock, you can sell them almost instantly on the open market, usually at the current market price. But if you own a diamond, finding a buyer willing to pay a fair price can take time, sometimes a lot of time. Unlike the stock market, there isn't a well-structured exchange or marketplace for reselling diamonds. So when you're in a pinch and need cash quickly, diamonds won't be the easiest assets to move. In the resale world, your options are limited. You could try to sell your diamond to a jewelry store, but most jewelers aren't interested in paying retail or even close to retail prices for second-hand diamonds. They'll often offer you wholesale rates or less, which are far below what you originally paid. Another option is selling through a pawn shop, which might give you cash fast, but usually at a steep discount. Online marketplaces are also an option, but they require time, patience, and effort. And there's no guarantee you'll get the price you want. In all these cases, you're facing a limited pool of buyers and low offers. Even compared to other luxury goods, diamonds are especially tricky to sell because they're highly individualized. Factors like cut, clarity, carat, and color all impact value, but buyers might not place the same worth on them as you do. So, while they may have high sentimental value, that doesn't necessarily translate to a high cash value when you're ready to sell. In short, the lack of liquidity means that diamonds aren't as easy to turn into cash at a moment's notice. Unlike more liquid assets, you might end up waiting a long time to find the right buyer, or settling for a much lower price if you're in a rush, and that's a big reason why diamonds aren't seen as a reliable financial investment. All right, let's dive into another key reason diamonds don't make for great investments. Their prices are unstable and unpredictable. Unlike traditional investments like stocks, which are influenced by more transparent factors like a company's performance or the overall economy, diamond prices can be much more complex and, quite honestly, volatile. Why? Well, diamonds don't have a standardized or universally accepted price, which means their value can fluctuate significantly depending on a number of unpredictable factors. Let's start with the basics. Diamonds are often influenced by market demand and trends. For instance, certain diamond shapes, colors, or styles can become more popular over time, driving up their prices temporarily. But if that trend fades, the prices of those same diamonds can drop just as quickly. This makes it hard to predict long-term value, as trends can be short-lived and unpredictable. Compare this to something like gold, which has a more consistent market value and a long history of stability. Gold prices are tracked globally and are generally more predictable because gold has many standardized uses. But with diamonds, you're dealing with a more subjective market. The price of a diamond isn't determined by a global market standard, but by what individual buyers are willing to pay at any given moment. Another factor is that diamonds are susceptible to economic downturns. When the economy takes a hit, luxury items like diamonds are often among the first to see a drop in demand. People are less likely to buy expensive jewelry during tough economic times, which means prices can drop as demand declines. This volatility means your diamond's value could take a hit, especially if you need to sell during a market slump. To make matters more unpredictable, the rise of lab-grown diamonds is also shaking things up. Lab-grown diamonds look identical to natural diamonds but come at a fraction of the cost. As these lab-grown options gain popularity, demand for natural diamonds could decrease, potentially lowering their resale value. For example, a diamond you buy today might not be worth as much in the future simply because more affordable alternatives are available. So, while diamond prices might hold or even rise for a while, the unpredictability of the market means there's no guarantee they'll appreciate in value. Unlike assets with a clear price history and established market value, diamonds are subject to changing trends, economic fluctuations, and the impact of alternatives like lab-grown stones, all of which can make their price highly unstable. In other words, investing in diamonds is a bit of a gamble, with no way to predict how they'll perform in the future. For most people, that makes them a very, very risky choice for anyone looking for a stable or appreciating asset. Lab-grown diamonds are exactly what they sound like, diamonds that are created in a laboratory. But here's the thing, they're chemically, physically, and optically identical to natural diamonds. That means they look the same, sparkle the same, and are just as hard as mined diamonds. So why does this matter? Because lab-grown diamonds can be produced at a fraction of the cost of mined diamonds, making them far more affordable. The price difference can be significant. A lab-grown diamond can cost anywhere from 30% to 70% less than a natural diamond of the same quality. So if a natural 1-carat diamond is priced at $5,000, a similar lab-grown diamond might cost only $2,000 to $3,500. This huge price gap is already influencing buyers, as more people are opting for lab-grown stones to get the same look and quality at a much lower cost. With lab-grown diamonds becoming more popular, we're seeing more jewelry brands and retailers offering them as an alternative to natural diamonds. Some brands are even specializing in lab-grown stones, pushing them as an ethical, affordable, and sustainable choice. And this trend is growing fast. One of the reasons lab-grown diamonds appeal to buyers is their environmental and ethical advantages. Traditional diamond mining is resource-intensive and often raises ethical concerns around labor practices, especially in regions with poor labor regulations. Lab-grown diamonds, on the other hand, don't involve mining, which means less environmental impact and fewer concerns around ethical sourcing. So, what does all this mean for the value of natural diamonds? Well, as lab-grown diamonds become more widely accepted, they're likely to drive down demand for mined diamonds, especially among younger buyers who care about affordability and sustainability. This shift could reduce the resale value of natural diamonds over time as the market becomes saturated with high-quality, affordable alternatives. In other words, a natural diamond bought today might be worth less in the future because lab-grown diamonds are meeting the same demand at a lower price point. And if lab-grown technology continues to improve and production costs decrease, this price gap could grow even larger. While lab-grown diamonds are an exciting development for those looking for affordable luxury, they pose a challenge for anyone hoping to buy natural diamonds as an investment. The growing popularity of lab-grown stones is reshaping the market, making it harder for natural diamonds to hold their value. So, while diamonds may be forever, their market value might not be. All in all, the emergence of lab-grown diamonds is a game changer. It's giving buyers more options, but also adding a layer of unpredictability to the market value of natural diamonds, making them an even riskier choice as an investment. Another important factor to consider when thinking about diamonds as an investment is that they don't generate any income. Unlike other types of investments, diamonds don't offer you any form of cash flow or returns over time. Let's break this down. When you invest in something like stocks, you can earn dividends, essentially a share of the company's profits that gets paid to you as long as you hold the stock. Real estate can also generate income through rental payments if you own a property. Even bonds provide regular interest payments. These are all examples of income-generating assets, meaning they pay you over time just for owning them. With diamonds, however, it's a different story. They don't provide any dividends, interest, or rental income. Simply owning a diamond doesn't put any money back in your pocket. In fact, it can end up costing you more, especially if you need to insure it, maintain it, or even store it securely. So rather than earning you money, diamonds can actually be an ongoing expense. Imagine if you invested $5,000 in a dividend-paying stock that yields even just 3% annually. Over 5 years, you'd have received around $750 in dividends, all while potentially benefiting from any increase in the stock's value. Now, if you put that same $5,000 into a diamond, you wouldn't see any returns over those 5 years, and you'd have no guarantee that the diamond would even increase in value. Essentially, it just sits there, beautiful but financially inactive. This is why many financial experts say diamonds aren't really an investment in the traditional sense. An investment typically works for you, either by generating income or appreciating in value over time. But with diamonds, you're purely relying on the hope that their market value might increase someday, which, as we've discussed, is far from certain. Another thing to consider is opportunity cost, the cost of choosing one investment over another. When you buy a diamond instead of a traditional investment, you're essentially missing out on potential income that those other assets could have generated. This means that not only do diamonds not generate income, but they also take away the chance for you to grow your wealth elsewhere. So, in a nutshell, diamonds may be beautiful, but they're not financially productive. They don't earn you dividends, interest, or rent, and instead, they just sit there, relying solely on the possibility of appreciation. For most people looking to grow their wealth, income-generating assets like stocks or real estate are a far more effective choice. In other words, while diamonds may hold sentimental value, they don't hold investment value in the way that traditional income-generating assets do. If your goal is to build wealth over time, diamonds probably aren't the best tool for the job. So there you have it. When it comes to buying diamonds as an investment, the reality is far from the sparkly image we often see in advertising. Between high markups, lack of liquidity, unpredictable prices, the emergence of lab-grown diamonds, and the absence of income generation, diamonds just don't stack up as a strong financial investment. Now, that doesn't mean diamonds can't have value in your life. They can be beautiful symbols of love and commitment, or a meaningful luxury item to enjoy. But it's important to know that buying a diamond is more about emotional value than financial value. If you're looking to invest, consider options like stocks, bonds, or real estate that offer income generation, liquidity, and growth potential. But if you're buying a diamond, just make sure it's for the right reasons and not with the expectation of future profits. Thanks for tuning in. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more insights on finance, investments, and lifestyle. And let me know in the comments, what do you think about diamonds as an investment? Would you still buy one, or would you consider other options? I'd love to hear your thoughts.